Hello, my name is Chris Edebar, and I'm going to be starting off this presentation on our group market study for Los Angeles. We're going to be starting off with the general makeup, and then be going over some current statistics before passing it off to other group members. So we're going to get started by looking at the properties and rooms by the submarket. So in LA, we decided to look at the top 10 submarkets across the area. And one thing that we find is that the Hollywood Beverly Hills and the LA airport are actually the largest submarkets based on the number of rooms. And then the CBD, the North, South Bay, and East are following up in order of number of rooms. And then the other submarkets are actually much smaller when you compare it to these other first previously mentioned submarkets. And one thing that we find is that what actually I think is interesting is that the Los Angeles airport has nearly half the amount of census properties compared to the Hollywood Beverly Hills area. However, the number of rooms are almost identical. So you find that these census properties closer to the airport are much larger when you compare in terms of number of rooms per property. When we look at the the properties and rooms by scale, we find that over half of the census properties is made up of independent properties. They easily take the majority of properties reserved in the census. However, what's interesting is that the independents, while they have more than half of the total number of properties, they have less than half of the total number of rooms when you compare it to the other scales. But if we're counting total number of rooms, then upper upscale would be second largest scale, and then upscale would follow shortly after. The least amount of rooms is going to be in the mid-scale chain. However, interestingly enough, the upper upscale chains has almost half the amount of properties compared to the upscale chains. However, the upper upscale chains have much more rooms, more not only in the total, but in terms of rooms per property when you compare it to upscale chains. Now, when we look at properties and room by class, we see that the economy and upper upscale have the most number of rooms by far. And then the upscale follows in second for total number of rooms. We see that the mid-scale class has a surprising number of properties, but so few rooms when you compare it to the luxury class, because the luxury class has much larger properties or based on number of rooms per property, considering there's only 69 properties in the luxury class, but they have 13,000 total rooms in terms of that economic class, while the mid-scale has 80 properties and only 5,500 rooms. Another thing that's really interesting is that the economy class is a similar relationship where it has a lot of properties, but has close to 28,000 rooms. However, the upper upscale class has like a fifth of the amount of properties, but the same amount of rooms. So these upper upscale class properties also have a large number of rooms per property. When we look at the properties and rooms by location, undoubtedly the majority of the properties are going to be located in the suburban and the urban marketplaces, just because that's probably related to the space in terms of being able to build, because airports don't have a lot of places to develop new properties because it's already been built on. And there's very few resorts because, like I said, the LA area is incredibly crowded. And so because of how crowded it is, there's really not any space to be building large scale resorts. When we look at the properties and rooms by size, um, surprising enough that a lot of the properties have less than 75 rooms. Or there's 700 properties that have less than 75 rooms, which makes up the majority of the marketplace by size, which is surprising enough because uh, the next two classes, or the next two scales, you could call it, 75 to 149 and 150 to 299. Um, both of those by themselves make up the same amount of census rooms as the properties with less than 75 rooms. Um, but not surprising at all is that there's very few hotels that have more than 500 rooms because, like I said in the last slide, there just isn't enough space within the LA area to be developing hotels of that size. Now, when we look at the the market characteristics, we wanted to focus on the demographics so we could understand who the customers were mostly comprised of. And so we look at the population, we see that there's 3.9 million individuals that live year round in the LA area. The median household income is $58,385. The age distribution is mostly 18 to 64-year-olds, the working class, which makes sense because the LA area is very business and leisure heavy. And so, um, that's the age where you can really be productive in both of those areas. The race distribution is um, really not surprising either. We see that as 52% white, 48% Hispanic or Latino, and there's also 11.6% Asian, 8.9% African American, and for individuals who make up two or more races, it comprises 3.6% of the population. And then when we look at the Los Angeles key statistics, we find that there's 1,059 rooms, or 1,059 hotels, sorry, as of February 2020. This is actually a record high for the entire market. And the other record highs include the room demand of 30.7 million for that month. And then we also saw that the room revenue had 5.5 billion for the entire market for that month, which is also a historic record for the area. Occupancy is relatively the same at 79.7%, and we saw no change in the ADR for that month compared to the month before. The total number of rooms is 105,908, and then we also see that the room supply is made up of 38.8 million.
will now be looking at the trended data for the Los Angeles market. So first we'll be looking at the actual supply and demand. So for the actual supply, we can see that from 1998 all the way until 1992, the actual supply is increasing rapidly. But we see that from 1992 all the way till 2018, we see that the supply remains steady, with then towards the end a slight increase from 2018 up to 2020. For actual demand, the overall actual demand is increasing. However, there are a few dips. The first dip is in 1991, the second dip is in 2001, and the third dip is in 2008. And we see that starting from 2008 all the way into 2020, that the graph is increasing, that the actual demand is increasing steadily with no dips. So next we'll be looking at the occupancy and ADR percent change. We see that for the most part, the occupancy and ADR percent change is above 0%, which means that they are positive. That is a good sign. So however, there are dips, and to be exact, there are three major dips. The first dip is in 1991 or 1992 because of a recession, and the second dip is in 2001, of course, because of 9/11. The tourism is majorly hit because of 9/11. Uh, the the third dip is in 2008, of course, because of another recession. We can see that for the most part, occupancy and ADR percent change are similar. When occupancy percentage increases, ADR percent change also increases. When occupancy percent change decreases, ADR percent change also decreases. There are times when there are differences, but for the most part, they are fairly similar. After that, we look at the actual occupancy and actual ADR. So you can see here for the actual occupancy, everything is above 50%, which is pretty good. So we can see here that there are also three dips, but after every dip, we see that the peak is higher than the previous peak. For example, here we see at 1992, it decreases until 52%, and then it bounces back and increases until 2000, which it reaches around 72%, and then it decreases in 2001, but then it bounced back and increases higher than the previous peak, which is 75%, in 2006 until 2008, and then it decreases in 2008, but then it bounced back and it's higher than the previous peak, and it reaches around 80% in 2016. For the actual ADR, we see that in the beginning it increases slowly, but as time passes by, it increases more and more rapidly. The final trended data that we'll be looking at is the RevPAR percent change and the actual RevPAR combined. So first we look at the RevPAR percent change. For the most part, it is above 0%, which is good, which means most of them are positive. With there are a few dips in 1990, of course, in the same as the previous slide, which is in 1992, 2001, and 2008. And for RevPAR, for the actual RevPAR, in the beginning it slightly decreases, but then it slowly increases, and as time goes by, it increases rapidly until 2017, and we can see that from 2017 until 2020, it stays stagnant, maybe with a little bit of increase. So if you notice here, for the RevPAR percent change is similar to occupancy and ADR percent change, and the actual RevPAR is similar to the actual ADR graph. This is because RevPAR is a combination of both occupancy and ADR. After trended data, we will now be looking at the market breakdown. The first three slides will be by scale, and the last three slides will be on submarkets. So first here we'll be looking by scale, which is the supply and demand percent change. You can see here that there are more scales that are in the positive. However, the number itself is higher in the negative growth. So you can see here for the negative growth, it's mid scale. Mid scale is the highest for both supply and demand. followed by luxury, and then by economy. While the rest in the positive are upper mid-scale, upscale, upper upscale, and independent. So for mid-scale, the supply and demand percent change is next would be the actual occupancy and actual ADR by scale. So we can see here for luxury, uh, the ADR has a very ADR luxury has a very high gap compared to the other scales. So we can see here, luxury has an ADR of 398. However, upper upscale, which is the second highest, have 189, and you can see there that is almost double. However, compared to from upper upscale to independent, the difference is not so much compared to upper upscale and luxury. For the occupancy, we see here that upper upscale has the highest, which is 83.8, and then second followed by upscale, which is 83.6. However, the occupancy is distributed fairly even, and it's looking pretty good because all the occupancy are up at least above 70%. And the last one for market breakdown by scale is the RevPAR percent change and RevPAR actual. So we can see here for luxury, the actual RevPAR is very high compared to the second highest, which is upper upscale. The luxury actual RevPAR is 315, the upper upscale is 159, and similar to previously, we see that the upper upscale, there's not much difference from upper upscale to independent compared to upper upscale to luxury. And now we look at the RevPAR percent change. For the RevPAR percent change, we see that most of them are positive, which is good. The highest is upper upscale, which is at 3%, and there is a negative growth, which is luxury, which is minus 2%. And we can see the overall, there's not much RevPAR growth because the RevPAR percent change is single digit and is less than 5%. And now we will be looking at the market breakdown for by submarkets. So first is the supply and demand percent change. We see here that Pasadena have the highest percent change for both supply and demand. For demand, they have 4.8%, and for supply is 3.8. And for demand, the highest demand, it's followed by Los Angeles CBD at 3%, and as well as Hollywood, which is also 3%. And for supply, the highest, of course, that I mentioned before is Pasadena, followed by Hollywood, and then South Bay. And there are a few negative percent change. However, it is still okay because most of them are below 1%. Next is the occupancy and ADR percent change by submarket. So the highest ADR percent change is Long Beach, which is at 4%, followed by southeast of Los Angeles, which is at 2.6, and then north of Los Angeles, which is at 2%. For the occupancy percent change, the highest is at Los Angeles CBD, which is at 2%. However, there is a very high negative growth for the occupancy percent change, which is in Santa Monica at 3.5%. There's also a high ADR negative ADR percent change, which is in Hollywood, which is at 2.4%. So for the final market breakdown by sub-market is RevPAR percent change and RevPAR actuals. So we can see for the RevPAR actual, um, the highest RevPAR actual is in Santa Monica, which is $262, followed by Hollywood, which is 242. But the difference between these two and the other actuals are very high because some of them are double or triple the RevPAR compared to the other submarkets. We can see here in Los Angeles Southeast, the RevPAR is only $83, while in Los Angeles it's $79. For the RevPAR percent change, most of them are positive, which is pretty good. With the highest is in Los Angeles Southeast with 3.6%, followed by in Long Beach, which is 3.3%. However, there is a high negative growth, which is in Santa Monica, which is 3.9%. However, as I mentioned before, the RevPAR percent change is doing pretty well because most of them are positive.
Hello, so my name is Gianluca, and I was responsible for the comparable markets part and the types of business. Now, real quick, the reason why we chose the select comp set is because first we were looking at proximity, so how far away is it from Long Beach, just to have a perspective. And most importantly, we wanted to make sure that those cities had the same type of business leisure mix. We know that LA is one of the strongest leisure vacation spots in the country, but it also has a pretty strong business market as well. The same goes for Miami, Atlanta, and New York City. We know that it has the same type of mix from the assignment number one. Las Vegas, it comes from personal experience. So on the weekends, people from California come over here. And on weekdays, we have a strong business market that goes to convention centers. San Diego and San Francisco were like the obvious choices. They are both hugely popular in leisure entertainment. They are both beach coastal cities, and they're basically in the same state, so they're our closest competitors. Now, if you look at the supply and demand percentage change, we can see that we had the third best demand growth among all the comparable markets. So that's a good sign. But our growth in supply is positive, but if we look at Miami, New York, San Diego, and Atlanta, we can see that those four markets are outclassing us. Now, talking about occupancy and ADR percentage changes for Los Angeles, Long Beach versus the comparable markets, we can see that even though the occupancy for Los Angeles, Long Beach was minimal, the occupancy growth was minimal, only 0.4%. It was the best one compared to everyone else, besides Miami, which was positive as well at 0.1%. And you can see that New York, San Diego, Atlanta, San Francisco, Las Vegas, they all had negative occupancy growth. For ADR, we didn't have any growth at all. It was zero. And it paled in comparison to Miami, Atlanta, and Las Vegas. Especially Las Vegas, we can see that those three cities are having a strong growth in ADR. Now, the analysis is a little bit different when we look at actual raw data, actual occupancy, and ADR. What we can see here is that Los Angeles Long Beach has the third best occupancy among all the comparable markets, and it's the fourth best in ADR. So it's right in the middle. We have 7 markets here. Yeah, it's right in the middle. And the California market, what we can conclude is that the California market is strong overall. If you look at Los Angeles, San Diego, and San Francisco, and LA, Long Beach is doing better than San Diego, but it can really compare to San Francisco, especially in ADR. Now to the other markets that are not in California, we can see that New York City is definitely outpacing Los Angeles, but we're either on par or doing slightly better than Miami, San Diego, and we're definitely doing better than Las Vegas. Now we're gonna change things a little bit and start talking about types of business. And I want to do the breakdown for weekday and weekend and analyze the data. What we can see in the bar graph here is that weekend is definitely doing better than weekday. It's around 6% higher in occupancy. And it's also pretty noticeable that the first period, so the one from March 2016 to February 2017, so basically the year of 2016, did better than the other periods. If we just focus on weekday, we can see that after the first period, then it started decreasing, but the latest period, so the one from March 2019 to February 2020, we can see that it had a slight recovery, so that's a good sign. For weekend, we can see that there's a gradual year-over-year increase in occupancy. Talking about weekday and weekend actual ADR, one interesting thing to notice is that weekday ADR is actually higher, around like $4 higher than weekends ADR. Even though in the last slide we saw that weekend occupancy was way higher than weekdays. What that tells me is that Los Angeles Long Beach is actually able to charge a higher room price from the business customers compared to the leisure customers that come on the weekends. So that's a growing opportunity for Los Angeles Long Beach, and that signifies that they should invest in this business segment. The other things we can analyze here is that there's a huge gap in ADR from the first period 2016 to 2017, and then the 2018 and 2019 ADR is basically consistent, just a minimal increases and minimal decreases. If we look at a scenario for actual occupancy by day of the week now, you can see that for the three periods analyzed, so from 2017 to February 2020, the occupancy is pretty consistent for all days of the week. There hasn't been any significant increases, but you can see that the highest occupancy is on Saturday, then followed by Friday, and then on Wednesday. What that tells me is that it supports the data we found in the two slides before, that occupancy on the weekends is higher. And what we can also see here is that what's really bringing the occupancy for weekdays down is Sunday. So that's the day that a lot of leisure travelers are going back home. Because if you look at just Monday through Thursday, the occupancy is pretty good. It's around the low 80s. And overall, what this shows me is that Los Angeles Long Beach, again, is able to attract both business and leisure customers. ADR by day of the week is also pretty similar. We can see that Sunday is the worst performing day by far. And I will also want to highlight Tuesday and Wednesday. These 2 days in particular, we can see that there's an increase in ADR year over year. It went from 182 to around 188. And what that tells me once again is that they're able to charge a higher price from business customers on weekdays compared to weekends from the leisure segment. Looking at just historic occupancy seasonality, this is a pretty good slide to see what the strong seasons are, what the low seasons are, how has occupancy fluctuated through the years. And what this tells me basically is that seasonality in Long Beach hasn't changed over the past 5 years. You can see that the lines are pretty consistent. One thing to notice that 2016 was kind of an anomaly. It had higher peaks than in other years, but that's okay. The peak season is obviously summer, so from mid-May to late August. And one thing that I also noticed is that from February to around April, so spring basically, they also had a pretty good occupancy. You can see right at the end that this massive decline starting in October. That indicates the start of the low season, the off season, so winter. And then it starts recovering back up in January. Now, if we just focus on historic ADR seasonality, once again, summer is the best season, no doubts about it. And if we compare to the previous slide, remember how I mentioned the bump in occupancy for spring? You can't really see this here for ADR, so that's interesting to note. And remember how I mentioned that 2016 was kind of an anomaly. It had higher peaks in occupancy. Now, this is explained why that happened because ADR has the worst performing line in ADR. So what that tells me is that for that year, the trade-off was they had a low ADR but higher occupancy. Right here at the end in the purple circle, I just wanted to notice that 2019 was trailing 2018 pretty well, except for this small part here in November where it performed a little bit better. I wonder if in 2020, the line for 2020 is going to perform even better in the low season. Now for the last type of business that we're going to analyze is group and transient and see the mix. We can see for the past decade that the mix hasn't really changed. Transient is always going to be higher and group is going to be lower. What does change a little bit is the percentages. So transit started at 70% and then grew to 76%, and group went from 20% to 16%. So what that tells me is that throughout the years, transit is gaining more market share, and that should be the focus for Los Angeles Long Beach going forward. There are quite some interesting things to analyze here when we look at actual ADR for group and transit mix. We can see that in 2010, the ADR for them was pretty much the same, and then they separated a little bit, and then starting like 2018, they started to converge back, and now in 2020, they're basically the same again. So it's interesting to see how transit got this big boost and distanced itself from Long Beach, and now it's coming back again in ADR, not in occupancy, of course. So the trend shows that there was a strong growth all the way up to 2017, 2018, and then it started to plateau for the past 3 years.
Good evening, ladies and gentlemen. We are doing the pipeline report for the area of Los Angeles, Long Beach, and Southern California, of course. And what we see here, we see that we have the submarket that we have here. We have luxury, and then upper scale and upscale and upper mid scale economy and independent. And also, as you see, we have the existing in construction and final planning and confirmed. So in this pipeline here, we're looking at some of tremendous changes throughout the year of 2020. And as you see, the luxury, up from the luxury all the way to the upper mid scale, it's been a pretty a good days or good report for those type of scales of type of class hotels. But the others, which is the mid scale and economy, it is compared to these guys, it is really low. But on the other hand, if we look at it here, and independent hotels, it comes in back and it goes all the way up to the independent hotels. So what we're looking here, we're looking at there is some changes, and the changes that are based not most likely on the construction of the building, but what we're facing here is changes of the status of the hotel, or the branding, I would say the branding of the hotel. So this tells us that most of the hotels in this area, and this changes from here, luxury, upper, all the way, and then down on the mid scale and economy, and then all the way up on the independent. This shows us that these hotels here, luxury and upscale, they changed their status, or I would say, in other words, a proper word, they're no longer part of a brand. They're no longer, they keep their luxury hotels building, but they become independent, and that's what gives us here on this pipeline here. It shows us that the independent hotels is higher than the others, which is the economy and the mid scale. But on this end here, we see that those changes is remarkable, because what's going on in the market, and most of the luxury hotels, they become independent, I guess, because of it comes from the customer, what the customers like. Sometimes customers, they don't, or they change their idea about a certain brand, and they don't want to stay in the hotels because of that brand. So most of those luxury, and also there is a lot of like conditions and circumstances to be part of a brand. So that's why we see this tremendous change. It goes up and then down on the economy and a mid scale, but vice versa on the independent. And that's why we have this tremendous change here on the year of 2020. I would say that there is other conditions that apply here, which is the era of the events that are going on, and all that's going on the Southern California, that may do a little change here. But most likely, looking at the pipeline report of Long Beach, California, and we see this tremendous changes from luxury apartment scale to directly independent, and that's why we see this big arc. And yeah, that's what most likely does the changes here on our pipeline report of LA.
In conclusion, Los Angeles is a large city with 9 submarkets, and most of its hotel is independent by scale and economy class by classes. And most of the hotels are in suburban and urban area, and only 90 hotels are in airport and 33 by resort. And the size of the hotels are mostly in small sizes that are less than 75 rooms. And for the trend report, the actual supply and demand are going up consistently, except by 2010, and there's a small size downturn, not too big, but start recovering since 2011. And there's two big downturn for actual occupancy and ADR, average daily rate, that starting from 2001 and 2009. On the other hand, in 2002 to 2003, there's a negative percentage change in revenue par, as well as 2009 to 2011. So there must be a good reason to research about. Because the decrease or the downturn on the year of 2001 and 2008 are the same time as the downturn for the revenue par, which revenue par happened between 2002 and 2003, as well as 2009 to 2011, which is closer to the downturn for occupancy and ADR. From the data of running 12 months of February 2020, we can see that there's a negative growth in both supply and demand for luxury and mid-scale. By scale, overall occupancy for all scales are doing really well, that are above 70%. Only luxury scale hotels have negative change in revenue par. Then for the data of Long Beach, that compared to other comparable markets, Long Beach doesn't have a very high percentage change in supply and demand, but at least it is positive. Doesn't like Las Vegas that have negative change in supply and demand. As well as no negative change for occupancy and average daily rate. And I think Long Beach is a tourism city or a vacation city, because based on the actual occupancy between weekday and weekend, that the weekend occupancy is around 80%, but for the weekday, it's only around 76%. On the other hand, the average daily rate for weekday and weekend are pretty closer to each other, and weekdays actual daily rate is actually a little bit higher than the weekend. And from what we predict earlier, that as a tourism city, Saturday has the highest occupancy of the week, but the highest average daily rate by day of the week is Tuesday, Wednesday, and Monday. And from what we see from the historic average daily rate and occupancy seasonality, Long Beach have its high season around summer from June to September, and pretty low from October to April. And its low season is pretty much around November to February, probably due to the national holidays. For the visitors, mostly are by transient, and group visitors are only taken up by around 20%. And in addition, from the additional data, what we researched about in the economy of Long Beach, that the GDP of Long Beach has been growing consistently since 2010 or in the past 10 years, as well as the property price. There's only two small downturn started from 2011 and 2015. For the takeaway, I believe the percentage between transient and group guests, there must be a really good reason to research about that, why there's a lot of transient but really less group guests. And for 2020, there's not much data we can see, but I believe COVID-19 must be done a big impact in Long Beach tourism. And the growth of the demand and supply has been really consistent in the past 10 years. And we should really research about the factors which cause the growth and to predict if the demand and supply is continue going to grow in 2020 and 21, or if there's gonna be a downturn. And Long Beach as a tourism city, is it gonna be potentially be renting up for submarkets in Los Angeles, like Hollywood, the biggest submarket in Los Angeles? For hotel companies, they should really focus on the new coming attractions or new developments for the beach that may increase the demand and occupancy, as well as companies and organizations should really look into the data about the percentage between outbound and inbound travelers in Long Beach. That I think inbound and outbound travelers should have different purchasing power, which will cause different percentage of increase in the total revenue. For the future, it's really hard to predict for big downturns, such as the downturn in 2001 and 2008. And the factors that cause the impact should be really figured out, so that we can know if there might be a factor that are similar to 2001 and 2008 in the future, and we can predict the downturn, and so that we can plan how to face the big downturn and save the business. And if the tourism business will be increasing in the future years, and companies can also figure out which kind of skills or classes of hotels is most suitable to build in the future and satisfy people's demand. And I believe Long Beach as a submarket with a good location, like oceanfront, it is really having the potential ability of becoming a higher ranking submarket in Los Angeles and making more revenue, probably similar revenue as Hollywood. And there really must be some good development that can be done in the future to develop the city for better hospitality business. And that's all. Thank you.